multiples right now are very attractive. And the work that we've done is, yes, there could be a 10% negative earnings revision to a number of our portfolio companies. But it's entirely possible that multiples are up 10 or 15% by the time those revisions come into place. So when we've done the high, medium, low expectations around what's going to happen if earnings adjust down, we believe the multiples are just too attractive right now to give up the opportunity to miss out on any recovery, because at least for the companies we own, it is very difficult to envision 25% or greater hits to their earnings.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Rob Cantwell and his team at Upholdings to discuss technology and successful growth investing. The pullback in tech stocks in 2022 has many asking questions about investing in tech, and we talked to Rob and his quant analysts about how we got here, the drivers of technology returns, the impact of inflation on tech stocks, and how and where we may identify opportunities in tech. With technology representing the largest sector in the market today and also in many investors' portfolios, we don't think this discussion could be more timely. As always, thank you for listening. Please enjoy this discussion with Rob Cantwell from Upholdings.
Rob, Lars, thank you guys for joining us today.
Great to be with you, Jack and Justin.
Rob, I guess the first time around wasn't too painful, so you're back for round two on Excess Returns.
Yeah, in spite of what the market has done since the last time we got together, yeah, we're still kicking.
Yeah, well, we couldn't think of a better person to have back to talk about the topic that we're going to talk about today, which is technology companies and tech stocks. For many investors, I think this sector is a very important sector for them. I mean, it's not only a very heavy weighting in market cap weighted indices, but I just think overall in investors' portfolios, tech has become more and more important. And so just given what's happened in the markets this year, Lars and I were talking before the podcast started, and I think the NASDAQ's down something like 28%. So this is obviously a big loss in the market, big loss in tech stocks specifically. And we're going to talk about, I think, that and sort of maybe some opportunities in the market today. But before we do, I wanted to start with just sort of talking about how we got here, or maybe the last decade in tech up until this year. So it's obviously been a very, very strong decade for technology stocks, probably the best performing sector out there for investors. And, one of the, I think, struggles for people like Jack and I that tend to run more traditional quantitative strategies is, we sort of missed it with those. It's like our models and our view of those tech stocks, even 5-10 years ago, is these things are, still overvalued based on most standard valuation metrics. So where we want to start with you is, what do you think people like Jack and I and models like we run, where did we get it wrong with those technology names?
Well, it's a fascinating place to start. I don't know that you guys have gotten anything wrong. I just don't know that these were the things you were looking for. It actually is really helpful. So to use one specific example as a use case, and I'm going to talk about Apple for a minute. Before I do, the investor that I learned from, Roger McNamee, he led the T. Rowe Price Science and Technology Fund back in the 80s. And he built his career around growth investing. And one of the things that he was always famous for saying was that the best products always outperform any forecast that any financial analyst can build for them. And we'll attempt to help dissect some of the reasons why that's the case. And what's the difference about what drives the business versus what can get modeled into an Excel sheet. So using something as simple and as commonly known as Apple, 2007, it was trading at 6 times revenue, but at a 41 PE, and it was growing about 40%. And if you were a financial analyst looking at that, you're like, well, that 40% is going to taper down into something in the lower double digits. And that's a really high PE, that's a pretty high revenue. They sell hardware, that's a really cyclical device. And so that's a scary setup to come into. And yet here we are 15 years later. The stock has compounded 24% over 15 years. It still trades at 6 times revenue, but its PE has compressed to about 23 times. So the two things that we see happen the most often that keep people out of growth stocks is, one, they underestimate the duration of growth for the ecosystem that has been architected. And then secondarily, they underestimate the expansion of margins that gets to kind of ride along with such a sustained growth rate over such a long period. And we'll get into it later in here in terms of what have been bigger themes that have driven, tech and earnings over the past 15 years. But I would really just start with those two things of underestimating the durability of the growth rate and underestimating the margin expansion that happens from companies that are able to sustain growth rates like that for so long.
Are there ways as a discretionary investor that you're able to look at certain variables, certain metrics that help support that underlying thesis or those characteristics? Like, can you differentiate those companies that can maintain the growth rates and the margins? What things do you look at?
Sure. And this is where I think some of the work that VCs do can be really helpful, because they attempt to do total addressable market work. They tend to go into and say, what Facebook is building is bigger than what any television advertising agency has ever been capable of, because they've captured so much time. And so for example, the way a growth investor looked at Meta Platforms a decade ago said, well, we've got all these dollars in TV and we've got this much time spent in TV, but we've got this much time being spent in social media, but only this many dollars. And so at a minimum, you're willing to underwrite the potential for that gap to close in dollars versus time. But where the compounding really sets in is that those social media assets were able to keep compounding the amount of time spent on those services over those periods. And so jumping back to the Apple example, in 2007, when people were trying to forecast iPhone sales, they were never thinking that, well, gosh, if there's 1 billion iPhones out there, then they're also going to be selling watches and headphones and chargers and all these other things that help add margin to the ecosystem. And similarly, in the social media environment, when you're able to capture that attention and build a captive distribution channel, people were posting, it was mostly games and Zynga coupons, and nobody could have forecasted that there would be quick swipe video product and e-commerce embedded into social media. And so the signs that we tend to look for is the user behaviors around under-monetized time or purchase behavior. And those will often lead you into the places where there's the potential for sustained growth outside of what folks are forecasting in the near term.
Speaking of Apple, I think our friend Tobias Carlyle has said this. I think Buffett put, roughly 30 billion into Apple in, what was it, 2017, 2018. I think it's worth, 130 billion today. And Toby says it's the greatest trade of all time, just because Buffett, took 30 billion and basically turned it into 120. And that's just an example of an investor sort of looking at a company like Apple, a technology company that maybe he didn't understand, but realizing that the fundamentals sort of support such a big investment.
Yeah, I mean, what was, when we look at that, Buffett has done so many incredible things, but one of them has been to not be afraid to step into industries when everyone else thinks it might be over. And it was actually as early as 2016 when Buffett, started making the big Apple investment, and that wasn't a dumb time to do it. The number of phone manufacturers had shrunk massively. You were basically down to a duopoly between Samsung and Apple. You technically had Xiaomi, but they were really kind of captive in China. And so it's interesting to see this move for him work so many times, where he cares less about how much the industry is growing and he cares more about, well, how high is the market share now of the business that I get to buy? And getting Apple at 10 times cash flow with a greater than 60% market share clearly has proved out to be a pretty good step.
How would you respond to this idea that technology companies and the stocks have benefited from historically low interest rates? I mean, I think there's, maybe potentially you hear two arguments. That one, these companies were, borrowing money, maybe at levels that were so cheap, and then, doing things like buying back stock or whatever, and that was kind of helping the stock prices. But then two, this sort of trend in the market where just the market was awash with liquidity and people and investors were coming up the risk curve and just buying, growth like or tech like names. I mean, do you think there's any validity in sort of that or no?
I think much more in the latter than the former. So growth in a low interest rate environment with a lot of low yielding assets, inevitably you get a certain amount of yield chasing. And you definitely saw that in the multiples of a number of companies. This started back with Uber. Back in 2014 and 15, they were raising money in private markets at $100 billion valuation. In 2015, there was a little private market bubble that was happening. It was less communicated because there were much less people accessing it. But it was that same FOMO concept of, man, this is where all the best returns are, so I got to get in there and I'm willing to pay any price in order to do it. And in 2021, you saw a really similar event take place. There's actually one other thing I would add to this, which was in the beginning of 2021, when you had the GameStop fiasco, that actually scared a lot of other hedge funds out of some of their best shorts. And one of the benefits of a well-functioning shorting ecosystem is it puts pressure on the other side of stocks that don't get so much benefit to them. And when you saw a lot of large hedge funds say, gosh, we don't want to have GameStop level risk in what we're doing, you actually saw a lot of the down pressure on some of these crappier tech assets go away. And we think that, as much as the FOMO, was one of the drivers that led to some of that 2021 excess pricing.
What do you think about the duration component of this? I was thinking about Tesla the other day, and one of the things about having not necessarily cheap capital, but really long duration capital is it's allowed a lot of these companies that may not have made it, I think, to make it. You could argue there were points in Tesla's, development where if they didn't have access to capital that was, with people who were thinking on a very long time frame, they might not have made it. And I'm wondering what you think about that, and if you're worried about that going forward. If that long duration capital is not available, will some of these great ideas, be able to make it to fruition like they have in the past decade?
There's a couple of pieces in there. The first I'm going to say is there is a very big difference between growth companies that have figured out a business model that generate cash somewhat early in their life cycle and those that require an enormous amount of upfront capital investment in order to get to, say, the level of production of a Tesla. And in our experience, it's the businesses that are actually self-funding, call it within the first 5 to 7 years of their existence, that tend to be the companies that have 30 or 40 year lives that just blow investors' minds from what the potential ultimately is in terms of the valuation they're able to capture. Tesla, I believe, it's a much more complicated company because of its financing has been all over the place. They were talking about becoming a private company just a few years ago. They were able to make it through as a public market company. It may have actually been a good thing for them to have that public shareholder pressure and getting profitable faster. The challenge in the car economy as a whole is that if you say you were to take, for example, U.S. spending on vehicles and GDP, for now more than 20 years, that has been declining. So that's one issue, is you have, as a share of all spend in the economy, vehicles are actually a declining portion of it. The second issue is that unlike Apple, because Tesla is still a car company, the average selling price per Tesla continues to fall. And as a long-term growth investor, that has always been, it's like semiconductors and industries in which you have rapidly declining prices of your unit products tend to be extremely cyclical industries. And that happens because there's such a huge level amount of CapEx investment that they're having to cover costs on their fixed expenses or their fixed upfront outlays. And that's why they're willing to push the costs down, push the prices down on the vehicles that they're selling in order to recoup that. So you've got a really capital intensive beast. It's likely to be very cyclical. This very may well not have been the top for Tesla. It could have another euphoric moment years from now. But as a capital intensive category in a declining share of the country's output, that's a very challenging setup for a growth investor.
Rob, can you just speak to the declines that we've seen in technology and growth names and sort of put it in context of, relative to other points in history? how does it look? And what's the big driver here? Is it recession risk? Is it higher rates? Is it the businesses were just very overvalued? What's going on?
We've been trying to bring more perspective to this recently. So let's start with the S&P 500. In the last 6 months, the S&P 500 has gone from 40 to 32 trillion dollars. So you've had $8 trillion of wealth leave the system. That 8 trillion represents about 40% of today's GDP. If you go back to 2008, we had about a $5 trillion write down in equity market assets. That again represented about 40% of GDP. So on a pure wealth relative to the size of output of the economic system, we are in an extremely comparable period to just 14 years ago. Now, to your specific question about how much has tech been a driver of this component, it was certainly one of the first. So Amazon alone is responsible for $500 billion of that 8 trillion wipeout that we've seen. So across the entire economy, you've got one company representing such a significant chunk of that. And e-commerce as a category in particular, we have seen has been a key driver of shortcomings in a lot of other downstream industries. So look no further than what Amazon's quarterly retail sales are doing, and that's been a leading indicator for the digital advertisers and for a lot of the other variable expense or variable revenue players in the ecosystem.
And to your point, I think actually when you combine stocks and bonds, I believe this is even a greater loss than 2008 because bonds have been going down simultaneously. I think the loss of wealth, has been so massive during this that I think it might even dwarf 2008. When you guys, when we went through the period where value struggled for a decade, we kind of took a step back after and said, all right, what are the lessons we can learn from this since, we've primarily been value managers? I'm wondering, as you've kind of gone through this, what are some of the lessons you've maybe learned managing a growth portfolio during something like this?
Well, one of the big investments we made a year ago was we already had the fundamentals side of our team built. And so, doing the diligence on individual companies and that sort of analysis was pretty well built. But on the quantitative side, we actually hadn't done much yet. And Lars, who's with us, who we'll hear from in a little bit, he joined us just a little over a year ago and has helped build out a lot more risk management tools and security identification around some of the processes that we already have. And so what we're trying to do today is build these two in lockstep, of having a really smart, quantitative approach that helps us see risks that we're taking that are not viewable to the fundamental stock picker that's sitting inside of transcripts all day. And trying to get those two to work in harmony together. So to give you an example of an extreme, so it's been very well publicized in the news about hedge funds that have had a hard year. Tiger's down a lot. Coatue, meanwhile, hasn't been. And the biggest difference between those two firms is that Tiger has remained a fundamental stock picking firm, while Coatue years ago started investing much more heavily into their quantitative analysts. And the performance of those two funds during this sell-off couldn't be more different, because there were a lot of quant signals that were screaming and going red back in October and November saying, gosh, some of these really exciting younger companies, their fundamentals are still great, but gosh, these valuations have approached levels that have no precedent in history. And there's a lot of risk here. And we certainly took risk out of the portfolio when we saw that. Clearly, we didn't take enough for the magnitude of the drawdown that we've experienced here. But I think the importance of layering a quantitative strategy onto any stock picking process has been the biggest learning as becoming a really essential tool here.
One of the things a lot of investors tend to do when you go through periods like this is they tend to look to history and say, what can I compare this to? And one of the big things you've seen this period compared to is 2000. And so since you're an expert in the space and since you've managed money through these periods, I'm wondering if you could maybe talk about, like, what do you see as some of the similarities that went on in 2000 and what do you see as some of the major differences now?
One of the biggest differences has been back in 99 and 2000, the definition of tech was pretty narrow. And the difference is today there have been a lot of industries built around mobile device proliferation, cloud software tools. There's been a lot of technological development in the last 20 years such that today you could almost call any company a tech company to a certain degree. And so the definition of what is a technology company has a much wider lens to it. So just from a fundamental standpoint, that's something that's very different about today versus back then. As it pertains to capital raising, valuations, ripping off investors, honestly, blockchain today feels more similar to 1999 internet than 2022 internet compares to 1999 internet. There's just you have robust franchises with stable investor bases that sure, short-term stock prices are down, but Meta and Google and even Apple, the ability of these businesses to continue to compound capital is unlikely to be hampered by the volatility that we've experienced in the last 12 months. By contrast, the blockchain ecosystem is likely going to look a lot different a few years from today as a result of all this pressure and liquidity that's come out of the system. So those are some of the parallels that we see to the 99 2000 period.
You alluded this to a little, but to me, as someone outside the tech space, it seems to me like the companies today are just much better than they were in 2000. Like there's better quality companies. There's companies that are more companies generating positive cash flow, who can generate positive cash flow if they want to. I mean, do you think that's a fair comparison?
Absolutely. I mean, our portfolio, in Kings looks tech to a lot of people, but we don't think of it that way. We think of Meta as our generation's AT&T. It is a communications company that's a little bit more capital intensive than your average tech company, but the connecting people in that way is a very durable asset that has a really long duration timeline attached to it. Now, not every technology company has crossed that chasm of changing from a disrupted technology into a long-term growing as some percent of GDP business, but we definitely think there's a handful of examples like that. So I'd say the digital advertisers as a group they're a mature industry. People are spending more time online than they are on their TVs. So as you approach the media space, we no longer see that as a tech or non-tech. We simply view it as, this is where the time and dollars are going. The enterprise cloud business is still a little bit in between that transition. So the IBMs and the Oracles and the SAPs of yesteryear, when they were building on-site premise hardware, those businesses started getting disrupted about 10 years ago. So we're not 20 years into that transition yet, we're only 10. And that's the one where we think there's the most opportunity for growth investors over the next 10 years, because the pace at which companies are adopting digital tools to either enhance what their employees are doing or replace what their employees are doing, we think is the area of most rapid change in business behavior right now.
One of the other differences I noticed, we were involved in an internet company back in 2000, an internet company that didn't make it. And, one of the things I've noticed this time is it seems like everybody is focusing on cash flow a lot quicker. So last time when we went through this, it took a while for everybody to kind of understand what was going on. But now it seems like, I know Uber on their call was talking about cash flow a long time ago. Like every VC seems to have a presentation out now saying to their companies, focus on cash flow. So I'm wondering if that'll make this maybe a little bit better than last time, in that everybody seems to have focused very quickly on, we need to generate cash flow, we need to reduce burn.
So what's interesting is that when markets get scared like this, investors' focus tends to move really quickly. So as recently as 9 months ago, there's too much emphasis on top line growth rates. And 8 months later, now all the emphasis is on cash flow generation. But make no mistake, there is another step deeper to fall. When we did experience this more in 2008, which we're not experiencing today, which is, where's your balance sheet at? Because today, we're not having balance sheet problems, and that's because the crisis isn't happening in over-levered banks. Instead what you have is growth companies that have raised too much cash, and now investors are looking at this and saying, why did you overcapitalize an opportunity that didn't actually have that much cash flow potential behind it? Robinhood is arguably the crowning example here. You got to check on the day, but I believe they're trading below their cash balance. And that's because the public investor looks at that. If we owned it as a private company, we could take that cash and we could ensure its deployment. But as a minority public investor, you have absolutely no ability to influence what happens with that cash. And if management burns it out in a few years of operating capital and raises more money at this very depressed share price, you've diluted the heck out of your shareholders. So we haven't yet approached balance sheet crisis level in the drawdown that we're in. But my honest answer is I think that this is it is a symptom of the cycle that we are in, that there's so much focus on cash flow generation. But there are still ample venture capital funding out there that is investing into new businesses that are less than 5 years old, that are still incinerating capital to put new companies together.
When you look at the overall valuation of tech after this decline, where do you think we are? I mean, we can, as quant investors, we can use simple things like PE, which we've kind of already talked about, are probably not all that valuable here. But where do you think we are in terms of tech's cheapness or expensiveness after this decline as a whole?
Well, at a high level, multiples are actually better than they were, coming out of the first quarter of COVID. But at a high level, we're seeing that multiples today are actually better than they were in the first quarter of 2020 when all the market circuit breakers were going off. And that was a combination of two things. There was actually quite a bit of improvement in fundamentals from the last couple of years of stimulus, but share prices have now come down so much that you're paying better multiples than you were back then. This is why a lot of folks are out there saying the final shoe hasn't dropped on tech yet. And below these, call it the mega cap tech and some of the mid cap tech, there are still some pretty high prices that you have to pay. Even a company like Shopify that has grown at a rate similar to Amazon back in their first 5 or 6 years as a public company, Shopify today isn't generating quite the same amount of cash that Amazon was back then. And as a result, the valuation on that business looks pretty darn expensive. And that's an example of one where, as we've been talking about, you want to see cash flow generation in the first decade of that business when it's out in the public. And for companies that still aren't showing that yet, their prices still have quite a bit further to fall. Now, I'm not going to predict what's going to happen in the future, but we're certainly not allocating into those types of tech businesses in this particular environment.
Do you think that there's been this narrative out here that high inflation is sort of like a permanent re-rating of tech, that tech companies for a long time now are going to be worth a lot less because of this high inflation, particularly if it stays with us? I mean, do you think that's fair?
I think that's a little bit narrative. I think the market's obviously forward-looking, and the issue with inflation is that we can't get bailed out of inflation. There's no money that the government can print to just save the economy here. Everyone's got to sit around for a while until inflation finally steadies itself, and then we're allowed to grow more again. One of my hopes is that it gets people to focus more on real growth rates for companies, because again, as growth investors, we're looking for companies that are penetrating. And if you're a business and you're growing 7 or 8% right now, you're not growing. You're just passing through price increases. You're not actually increasing your base and giving yourself more customers to sell in more products to. So we definitely think inflation, which is not something that at least our generation of investors have had to deal with for many in their entire professional careers. The unknowns of dealing with a new issue like this is why we think the multiples have come down so low. But we do not think that this level of multiple re-rating properly reflects the durability of many of these businesses. And that's, of course, why we remain invested in the companies that we are, and we're finding more risk in the portfolio where we can.
You alluded to narrative, and it's interesting because, if since we're quants, if you look at the data in terms of are high rates better for value versus growth, the data is very, very mixed. I mean, maybe slightly, but not by a lot. And so, but narrative can take hold here in the short term. And so you sort of had this year, this idea, high rates are coming, inflation's coming. We need to buy value. We need to sell growth. But, maybe with the long-term data, it doesn't hold up as well as many people think.
Lars did some work around the 10-year. You want to share some of the findings that you saw there?
Yeah, sure. So I'm Lars. I'm the quant here. And so a lot of this stuff that I do can be related to rates and inflation, especially recently. And so one of the things we found was that multiples obviously move in the opposite direction as rates do most of the time. But an interesting thing is if you look at multiples over time for the S&P 500 or for tech as a whole, they're more related to growth rates and margins than they are the interest rates. And so if you run a regression on the multiples, a lot of the times you'll find that the interest rate is actually not statistically significant once you account for these margin and growth rates. That being said, those margins and growth rates often move with the interest rates. So as interest rates move up, cash is not as available. And so you start to see those margins compress a little bit. And so in theory, as you're valuing a company many years out, instead of taking down your multiples, one of the things that you can look at is how are the margins going to change and how are those growth rates going to change if inflation stays where it is, if it comes down, and you can sort of model it that way.
Which is sort of funny. We're willing to be more optimistic on multiples in the long run than we are, say, some of the growth rates and margin profiles to get there.
Yeah, one of the other interesting things with inflation, I was listening to this, I don't know if you heard this podcast Patrick O'Shaughnessy did with Aswath Damodaran a while back, but he was kind of talking about tech and inflation, and one of the things he highlighted is we really don't know, forgetting about the discounted cash flow part of this, we really don't know how these tech businesses are going to hold up to inflation because we've never seen it. So people assume inflation is bad for tech businesses, but the reality is, we don't know whether someone's going to cancel their Netflix subscription. We don't know a lot about the pricing power of these businesses necessarily in an inflationary environment. So, it may not be as bad on the business side as a lot of people think. I mean, do you agree with that?
Well, this is where we believe traditional investment rules apply, which is how good is your market share and how good is your pricing power? Because Instagram ads are so much more expensive today than they were 5 years ago, 10 years ago. And as we look out into is the market share there to maintain the captivity of that audience or that real estate? And so Instagram ads are going to cost a lot 5 years from now. And that's one of the biggest shakeouts that you saw in tech was you had so many of these direct consumer brands that were trying to operate these independent websites, and they were advertising on social media, and then inflation hits. And you see digital ad prices go nuts everywhere, and it actually priced a lot of businesses out of the ecosystem of being able to acquire customers on social media. So that to us is an example of a very healthy business to own in an inflationary environment, because I can't predict who the advertisers are going to be 5 years from now, but I know that that's the place where consumers are, and consequently, whoever's got the money, that's where they're going to be putting their products and services in front of people. Now, again, going back to some of these capital intensive or these price declining industries, that is where there is a lot of inflation risk. Because again, taking the Tesla example, their capital expenditures are incredibly inflation sensitive, because you're talking about people and you're talking about parts and machines. And that's very expensive. And when you're in a declining price market with rising input costs, who can forecast the margins of that? And it's one of the big reasons why the auto industry has been so notoriously cyclical, is because of some of the dynamics that inflation and interest rates can play into it.
It seems like, to your point, I mean, we really need to look at these as probably individual businesses rather than technology as a whole. If you look at all businesses but tech, some will do well in an inflationary environment, some won't. And, people I think tend to put tech like all in one basket. But the reality is, like you said, I mean, some of these are businesses that are probably built to do very well in an inflationary environment, and some of them are probably ones that aren't.
And so marketplaces, captive advertising platforms, even the cloud enterprise software folks, they have a lot of pricing power. Their only drawback is they don't get to flex it very quickly because they tend to renew their contracts at least annually. So there's some lag to that inflationary pricing pressure coming through. But there are definitely spots within tech. Our largest positions right now are ServiceNow and Meta. And we believe those two businesses have stronger pricing power than 95% of the other investable choices out there in the public. The one area I would also share that we think is pretty interesting is the payments ecosystem as a whole. So you've got Visa and MasterCard, which have obviously held up, whose durability has outperformed anyone's expectations, even with many of the blockchain fears last year. So you've got them as the backbone. But then you've also got these newer online payment processors that are dethroning the Fiservs and WorldPays of the world. These are companies like Stripe and Adyen and dLocal, where once this software gets installed, that is how these companies are collecting their revenue, basically for the lives of those businesses. And so when you're looking for for companies whose revenue is going to naturally rise with prices or with inflation, the payments ecosystem is a particularly good one, because as money supply increases, prices rise across the market. We don't have to predict which categories and industries are going to rise their prices, because we've got the payments ecosystem drawing in its revenue from a very diversified set of companies.
Yeah, I want to move on and talk about sort of how we might think about like constructing a quantitative strategy in this space, or whether that's even possible in a minute. But first, I want to ask you about private companies, because I believe your ETF was the first ETF that was able to hold a private company, and I know you have a lot of experience in that space. And what you tend to see right now in the private company space, I think, is some degree of denial in terms of the multiples have come down a lot on the public companies, but a lot of private companies don't want to do down rounds. They don't want to admit the businesses are worth less. And I'm wondering I just want to get your take on that, like how you think about valuations in the private space right now and how they relate to what's going on in the public space.
Well, in short, it's a pretty bad time to invest in the private space for the reasons you listed, but also because if you were a good private company, there was an incredible window to go public over the past 2 years. And most of them did. You had Airbnb come out. You had a number of other, smaller and mid-cap tech companies, come onto the scene. So now that window is closed, you're asking private market investors not only to take this valuation risk because they haven't necessarily adjusted their prices as quickly, but now you're also asking them to take more liquidity risk than is normal. So you're asking about analogs back to 99 and 2000. The IPO window more or less just completely shut. I think it was, when did Netflix go public? Was it 2004? So you're talking about a 3 or 4 year period of nothing. And so we're on the sidelines on the private side right now. As you mentioned, Airbnb was the example of the private investment we had when we came public. And then they obviously became a public company, and that allowed us to adjust it in our portfolio in a beautifully tax efficient way. But as we look going forward, we're being patient on the private side because we're also seeing other private investors try to make more investments in the public market, given the relative attractiveness of prices and assets there. So I don't think the average investor is missing out right now by not accessing private companies.
One of the things we've been looking at, whenever as a value investor, one of the things I always do is whenever I see price go down on something, I get interested in it, which is not necessarily the right thing, but that is sort of the way I do it. And we've been looking at thinking about constructing a quantitative strategy in this space. And one of the challenges for quants in the growth space is, if you look at the value space as a whole, value stocks on average will outperform. If you look at the growth space as a whole, like just looking at something simple like sales growth rate or something, that universe will underperform, but the absolute best companies will come from that universe. So it becomes like this diamonds in the rough type thing, which is very hard to do quantitatively. And so I'm wondering what you think about that. What do you think about the ability to run sort of a quantitative strategy and be successful in the growth space?
It's a great question. One of the biggest things that we've done this year in adjusting our portfolio is we used to similarly be attracted to share prices rapidly falling, hitting 52-week lows, seemingly at some great discount to the historical valuation of the business. However, one of the things we've at least seen in this latest crisis is that there has been a collapse in fundamentals commensurate with the drop in share prices in a number of areas. So in our recent investor letter, one of the examples we shared was Netflix. Netflix had this incredibly large subscriber base that promised another 5x increase in their subscribers over the next 10 or 15 years. And then recent fundamental events suggested to the management team that perhaps their growth opportunity for subscribers was 70% lower. And the stock fell 70%. And that's perfectly justified given the potential smaller amount of addressable market for the company to go after. So that's an example of where stepping into a lower share price, you're not actually necessarily buying more of the business because the outlook and expectations have in fact truly changed. Now, by contrast, ServiceNow is the biggest example that I can give so far, which is you have a stock price that's more or less down with the NASDAQ about 30% year to date. But their free cash flow that's still up at least 20% this year. There's been maybe a 2% revision to their free cash flow estimates. So you're talking about essentially no change to the fundamentals of the business, which means that 30% drop in share price actually reflects a 50 or 60% drop in the price to buy that company, because the fundamentals have continued to accumulate. So I would start there if I were trying to build a quantitative strategy. I would look past the share price decline into the multiple decline for companies that are still compounding cash. Lars, you actually did a little more work here as well that I think is worth sharing.
Yeah, sure. So on top of that, we've run studies to sort of find the factors that move stocks, and we found that with a few industries in particular, energy as an example, about 60% of the movements have to do with the sector as a whole. So a lot of that in energy is due to oil prices changing, whereas in tech as a whole, about 30% of the movement in stocks is related to the sector as a whole. So if you are going to be running some sort of quantitative strategy, tech is actually a great bucket to look into, find those diamonds in the rough, because there's going to be the outperformers, and hopefully they'll be able to show themselves ahead of time, whereas a lot of the picks in the energy space are taking a bet on energy.
And one more I'll add on top of that, because we did a lot of similar work around the 52-week lows and stuff like that. And Lars actually found that the number of new highs that a company achieves is actually a better predictor as to whether or not it's a long-term compounder. And that's a fascinating one to me, because there's so much built into that. You think at first, you're like, oh, well, that's a momentum play. But no, because you can layer in valuation multiple work there, because maintaining new highs, part of that is management teams that are keeping market expectations low enough that they can serially outperform it. And if we want to get into some of the more technical aspects of growth investing, stock prices don't go up because revenue goes up. They go up because revenue exceeds the expectations that the market has built into it. And so finding these situations of, like I mentioned, share prices that achieve record numbers of new highs has been also a very interesting place to look, where we found some of the highest quality businesses.
Yeah, and listening to your response to that, I mean, it seems like growth is a place where you want to blend the quant with the discretionary together, because looking at your analysis of Netflix and ServiceNow, like, there's no way I'm going to quantify that. So my pure quant strategy probably wouldn't work in that space, but like what you guys are doing in terms of bringing it together seems to be the way to do it, versus value, where maybe we could run a pure quantitative approach.
Yeah, we'll see. We've all got our investment approaches that we, very, very diligently execute. But I think people always ask for investing can't be learned overnight, because there is the nature of the job that is learned from the experience of investing versus the study of investing. And over time, it's clearly, folks, we were talking about Buffett at the beginning of this, he has allowed himself to adapt to new industries. And that is one of the hardest things, to do as an investor, is to be an expert in an area and think that, well, gosh, I can generate alpha over time as an expert in this space. But if that space just is not going to do well for some set of factors, it doesn't matter how well you know it. And getting back to some of the things we were saying earlier, my background is primarily in consumer internet, and consumer internet has done fabulously over the last 15 years. But as you see with Netflix, there isn't quite the remaining growth opportunity today for some of these assets as there has been over the past decade. And as an organization right now, we're forcing ourselves to become more knowledgeable about this cloud enterprise space, because we think it's going to be one of the most exciting. So if you only spend time putting a lot of quantitative measures on one industry, that's where I'd point the gun.
I want to ask you about earnings, because one of the things we've seen so far is, I think, and correct me if I'm wrong, I think a lot of what's gone on so far has sort of been a multiple re-rating for technology stocks. And then you've got the debate out in the market right now where a lot of people are saying, well, the next shoe to drop is earnings are going to fall. So now you've got these lower multiples, but now these lower multiples are going to be applied to lower earnings as well. And I'm sure this is different for every technology company, but I'm just wondering for your thoughts on this idea that we've got this major earnings drop coming in the future for technology as a whole.
Well, we likely have an earnings drop coming, not just within tech, but within a lot of places. And this is where I think investors have to, have their own, conversations with themselves about what is the duration of your fund, what is the level of volatility you can stomach, because multiples right now are very attractive. And the work that we've done is, yes, there could be a 10% negative earnings revision to a number of our portfolio companies. But it's entirely possible that multiples are up 10 or 15% by the time those revisions come into place. So when we've done the high, medium, low expectations around what's going to happen if earnings adjust down, we believe the multiples are just too attractive right now to give up the opportunity to miss out on any recovery, because at least for the companies we own, it is very difficult to envision 25% or greater hits to their earnings this year.
And I think on top of that, one of the things that makes the industries that we look at really attractive are the underlying fundamentals of the company are not cyclical. So software as a service or cloud software, for example, those revenues keep coming every year on top of the base that they're growing. And so while prices of these stocks are going to move up and down, and some see that as a cyclical, it's really the underlying is moving straight line up and to the right while the prices move, which allow you to get better prices. Whereas some of the other industries, the underlying fundamentals of the company are moving cyclically with the rest of the economic market. And so that is sort of why we're able to pick off good prices of good companies in this space.
One of the questions that we like to ask, and we like to think about it to ourselves, is this idea of these pre-mortems. So when it's, that's the idea of when you have conviction about an idea, where you might be wrong about it. So I'm curious if you think about technology, and again, we can't just lump all technology companies into one bucket, because as we've talked about, there's different qualities and characteristics and factors that are important that go into the better performing companies versus the ones that aren't. But if we were to think about tech and trying to sort of think where some of this might be wrong, if we were to look 5 or 10 years from now, and some of these names don't outperform, I mean, what might cause that? Can you think of anything that might result in relative underperformance?
As growth investors, we have a very natural optimism bias. And that can hit you like a bucket of cold water in the face sometimes. If I had so we talked about growth drivers earlier in this. We talked about mobile phone adoption over the past 20 years, creating opportunities. We talked about the internet exploding as an additional distribution channel, and we talked about regulation. Regulation can create opportunities for growth companies. It's built tons of natural monopolies in our own finance industry. But it can also very quickly shatter companies. And not necessarily by separating them, but so to use a very plausible example, if you were to look at Meta's revenue growth and Google's revenue growth and some of our largest technology companies, most of their growth is in fact coming from outside of the United States. It is not difficult to imagine a future in which countries say, hey, China shut down its borders to outside technology and they got a ton of thriving technology businesses inside their economy. It is entirely plausible there's a future of supremely more aggressive regulation that completely alters the fundamental profiles of these companies that have been compounding for years. So I would say aggressive regulation measures is at the top of the list of potential surprises. Technology development, folks have seen, these companies disrupted these old companies, so who are they going to get disrupted by next? That is not a narrative that we are seeing evidence of actually happening. I gave the Visa and MasterCard example earlier, where it turns out most of the fintech companies that are being successful in some way or another are actually riding on top of the Visa or MasterCard network. So we don't see surprise technology advancement as an enormous risk, but the regulation one can just completely change the game.
Do you think there'd be any validity? Like I'm thinking of Microsoft. Like I think it's when you look back to 2000, I think it might have had a PE of 50 or 60, and then we went through that bear market, and then something like from '03 to like 2009, Microsoft's business tripled or something. Like its earnings tripled, but its stock went nowhere because it was just expensive, and I think investors felt burned just necessarily by tech in general. And so it took a long time for investors to realize the value of Microsoft. And then over the last like decade, I don't know what Microsoft has done. It's probably been a great performing stock as the price ultimately caught up with the fundamentals. But do you think there's a risk to that maybe with some of these companies, or maybe not?
Oh, is there a risk that we're treading water for a while?
Yeah, that we're just it's sort of dead money.
Well, that's what's happened a bit over the past 18 months, driven a lot by what I'll describe as the surprise capex. So Amazon overbuilt its footprint. Meta bought back shares at the wrong time and also ramped up its capex to user numbers that they haven't quite lived up to. So the expansion in the capital expenditure budgets of these companies has definitely scared investors about what the free cash flow is going to generate. So when we look forward, you actually have both of these management teams with pretty good governance structures beginning to communicate that they're not going to continue growing their capex at those rates. So even if the macroeconomic issues are slow, and revenue growth isn't that terrific, and pricing is mediocre, these businesses actually have the ability to naturally expand their free cash flow simply off of a more rational capex base. So that's one of the few things that kind of gives us comfort about holding these companies down here at these prices. I actually think I think Microsoft is an outstanding example because it was a very neutral stock. I think it was from 2011 to 2014 or something like that. And it may well be the case that we're sitting in a very similar example with that with Meta and Amazon today. However, as you pointed out, that 2013 to 2023 run, 2022 run of Microsoft has been nothing short of astounding. And again, we think Meta and Amazon have the characteristics of a Microsoft that position it where even if these are flat stocks for a couple of years, they are still building up the time and users and products to be really big compounders over a longer time period than that.
Yeah, I think that probably highlights the importance of your patience and discipline in holding these names. Because like you pointed out, and I think Lars pointed out earlier, the businesses that you're buying, that you're holding in the portfolio, they're improving their underlying fundamentals, and the stock will eventually follow, but you might have to be patient and you might have to sort of wait there. So just in terms of that, I'm curious, what is your, of the portfolio of stocks that you hold, what's your average holding period, would you say, generally? Is it multiple years that these things are held in the portfolio?
It's a good question. The fund, we've been operating this fund for 3.5 years now. I'd say probably about 5 of our 25 stocks have more or less been in the fund over that entire period. But you're also, talking to an emerging manager that has spent the past 3.5 years, doing all sorts of different research, trying to find the best possible companies to hold. So if you look at our portfolio turnover rate over those 3.5 years, it has shrunk considerably. We've gone from 200% portfolio turnover, now we're down to the 60 to 80% range right now. It is, for our strategy, it is our anticipation to continue to drive that turnover lower. But again, I'm not going to predict, quite what the market holds for us in the future.
Well, the nice thing is the ETF is very tax efficient. So just a couple more questions here. I'm curious, you've been through a lot of different market cycles and obviously studied market history. And one of the things with, when you look at the S&P 500 over a long period of time, if you were to take like snapshots of the S&P over every decade and the top holdings in the S&P, businesses change, capitalism and markets change a lot. And so those names tend to be very different over, each decade. It used to be railroads and, maybe AT&T was in there and then IBM and what happened in the 70s. And then, but since the 2000s, it's been a lot of technology in there, and there's still a lot of technology. Technology is very heavily weighted in the top names in the market. Do you think that that's likely to continue, that the most valuable companies in the market will be centered around something around technology. And that trend is just here to stay. And maybe technology in the future could be defined very, very differently than we're defining it today. But I'm just curious in your thoughts on that.
Yes and no. So if you looked back at 99, 2000, I'm pretty sure it was Cisco. So there was a lot of physical networking equipment that was growing really quickly at the time. One of the things everyone talked about this, stock market boom and internet boom of 99. There was an equivalent CapEx boom from all of these management teams that were saying, oh God, we need to compete with this thing that's the internet, and we need to buy all these routers and network equipment in order to become internet companies overnight. And that was one of the biggest mistakes a lot of management teams made during that period, but it pushed a lot of networking companies into the top of the index at the time. So I don't think networking equipment is coming back anytime soon. To the top of the index, it's one of these categories of declining prices, heavy capex, lots of competitors. Within the digital advertising space, or in communications, as we've been talking about with Meta, it is very difficult for us to imagine a future in which those companies are not in the top 10. We're not seeing, like I mentioned, the disruption truly taking place. The only reasons that we sell stocks as growth investors is if we begin to see a material deterioration in the market share of that business, or because sometimes we'll invest in earlier stage stuff. You've got a management team that time after time fails to deliver on the goals that they set for the company, because it means that their product and technology is not nearly as disruptive as they're advertising it to be. So I'd say those are the two big drivers. And in the big, if we were to say Amazon, Google, and Meta were our three biggest tech companies, and I would throw Microsoft in there, I'd take a friendly side bet that those four companies are all in our top 10 another decade from now. And then I'd place another bet that says that these emerging enterprise cloud companies are the next potential entrants into there. But I do not think that we are now at the beginning of a cycle. We are going to begin to see big tech names fall out of the top index. From our perspective, it's more of a risk management approach of, well, how much potential is left and who are the likely future entrants into that.
This has been great, guys. And we have a standard closing question we like to ask all of our guests. I think you can go anywhere with it. It can be tech related, or it can just be, general investing sort of wisdom and knowledge. But the question is, based on your experience and research in the markets, if you could impart one lesson or one piece of wisdom to the average investor, what would that be?
You guys asked me this in advance, and I tried to cycle through like 100 different ways to answer it. All I'll say is that investing, it's like any professional discipline. Whether you're a professional athlete or a professional poker player or a professional utility repairman, there's 100 different things that you happen to be doing correctly. When you've achieved call it the top echelon within your professionalism, and investing is no different. I've been investing now for almost 18 years. And there's mistakes that I made in the first 7 years that are very difficult to think back upon. But each one of them built little sort of muscles and awareness and tools, that I've been carrying with me. And so I think it helps you stay humble as an investor to look back and know how many mistakes you've made. You're going to keep making an enormous amount of mistakes in the future. And so the only thing that you can control is every single time you make a mistake or a bigger mistake, what is the thing that you've learned? You need to take the time to reflect on what you need to learn from that, or something you need to change in your process to at least remove the potential of that mistake to come back again, because you're going to make a new one coming up. So that's what I would recommend from a process development standpoint.
Great. That's good stuff. Well, Rob and Lars, thank you guys very much for joining us. If people want to learn more about your firm, the ETF you guys run, or anything else, your research, where can they go?
Twitter is probably the best. Yeah, at Upholdings. We share a lot of research there. And from there, you'll find everything else we do.
All right, guys. Thank you very much for joining us. Hope you guys have a good rest of your summer.
Thank you.
Good to see you, Justin. Check.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.